So let's go and talk today about trading futures on crypto and Forex contracts, because there are a lot of possibilities in the financial market to place your efforts. You could concentrate more on crypto futures, or you could concentrate more and trade more Forex CFD contracts. But actually, what's the difference? Then we talk from the perspective of the one trader. If I apply all my efforts to trade with financial assets, I will be able to sustain the volatility of the market and gain some profit. And then I'm in profit if I will be able to get my money back from this trading platform to my banking pasar. Actually speaking, it's not a simple question because it depends from one side from my ability to trade with consistent profit and on the platform itself on which I place my trades and grow up my deposits. Then I trade with Forex pairs like Euro or Cable or CFD contracts like gold. It means I trade on some broker like TradingView Capital, Oanda, FXCM, and so on. All these Forex brokers claim that if you have a small account, your orders are executed against the broker on their own server or potentially against other traders of this broker. And when you become large in size of orders, your orders will be sent to liquidity providers, which means to outside markets or exchanges, like the Intergar or LMX, for instance. Some Forex brokers claims that they always sent all your orders to external providers, but of course it's not true, as they bet that small and inexperienced traders will lose funds. Then we talk about crypto futures like futures on Binance exchange. For instance, the situation seems at first glance like the same. That means that you trade on Binance with crypto futures and you trade against Binance itself and other traders of Binance platform. And if you lose either to the traders or to Binance itself. Actually, there is no real exchange execution. Majority of orders on crypto exchanges are executed against on crypto exchange itself, as they bet that small and inexperienced traders will lose funds, just like classical Forex brokers. So trading crypto futures, we are trading in conditions equals to trading CFD contracts. On first glance, it looks like there is no difference at all. However, the big difference is that there is no liquidity provider for crypto exchanges like Integra or LMAX for Forex brokers. And what it means in practice? That means that crypto exchanges are obliged to liquidate all these positions, which are against their interest. Binance first introduced BTC liquidations in 2017 to replace liquidity providers, and other crypto exchanges followed. BTC liquidations actually mean the robbery of the trader's deposit, but it's some kind of a polite way to say that. Just looks here on this chart, this amount of short positions that were liquidated, and this amount of deposits of short sellers lost all their money. Their money was pocketed by the Binance and other crypto exchanges. And if we talk about long liquidations like that, that means that this amount of money was pocketed out from the deposits of future traders to the pockets of crypto exchanges like Binance. Here is the big and great difference between trading Forex CFD and trading crypto futures. If we talk about Forex trading, you can see that there is no frequent spikes. For instance, there is no liquidation on gold. But if you see the crypto trading, you could see, for instance, that there is very long tail. But what does this tail mean? This is actually the liquidation of longs, and we need to understand it very clearly. If you compare the prices on trading Bitcoin on spot as the currency versus BTC futures during this week, you can see here a much longer tail. This is a moment when deposits of long holders were liquidated. That means that Binance as an exchange actually drives this price so low, artificially so low, that it takes to its pocket 99% of the deposits of traders who had long positions in Binance Bitcoin futures. And this is liquidation. What it means, the liquidation, but actually it's a robbery of traders. And then we talk about the billions of CZ, the head of Binance. You see, it's not billions from commissions. We need to clearly understand that these billions come from two sources. The first, of course, launchpad of shitcoins sold to naive crypto investors, but this is a story outside of this podcast. And the second source of these billions is actually liquidations of traders' deposits, sheer robbery of traders. So now we can more clearly understand the difference between trading crypto futures and Forex CFD contracts, the difference in probability to stay alive and health with large trading deposit. Trading gold and different Forex pairs is much safer than trading crypto futures, because if your deposit becomes big, you could split your money between different Forex brokers, or you could find the Forex brokers, which guarantees that all your orders will be routed to the LMAX, to the liquidity provider. But if you grow big with your trading deposit on Binance, you become subject to deposit liquidations. Binance will drive Bitcoin futures price against you so low or so high that you will lose your positions and your deposit at all. So given this situation, I actually decided to shift from trading crypto futures to trading Forex CFD contracts, because all these liquidations are actually designed as a way for robbery of traders' accounts, and I don't want to be exposed to this kind of liquidations anymore. So guys, thank you for your attention and good luck in trading.